Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Brendan Ahern, CIO at Crane Shares. In this edition, we talk about an in-focus topic that all investors should be concerned about, China. We look at what has been going on in that market, the impact of Trump, and the key areas of the Chinese market that you need to watch in the months ahead. So if you have any questions or comments, make sure to send them in to podcast@zacks.com. And don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Brendan right after this. Okay, Brendan, thanks for joining us to talk about a topic that has been on many investors' minds lately, and that is China. People have very mixed feelings regarding investing in China these days. So let's start off with the most important question. Is China a good investment idea in the age of Trump?
Regardless of who is residing in 1600 Pennsylvania Avenue, there's great opportunities, we believe, in China today, particularly geared to the domestic consumption, which is really a story that's not been very well told here in the United States, but it's certainly a very, very strong theme from both an economic perspective in China, as well as putting one's investor's hat on, a great opportunity potentially.
So you think investors should sort of look past this whole Trump issue and more focus on the fundamentals for China. Is that fair to say?
I think certainly if one is going to enter a trade negotiation, you want to assemble a group of people who have some experience in this. And certainly within the trade cabinet, trade representatives, you have some people who certainly can be defined as China hawks. I believe we've seen a little bit of an evolution of some of the dealings with China. The most recent conversation between Trump and President Xi, as well as new members of the cabinet taking a higher, more prominent role in economic and trade. So Gary Cohn, who formerly ran Goldman Sachs, as well as Steve Mnuchin, another Goldman alum, they're going to have a very different perspective on trade and the importance not only for U.S.-China relations, but the effect it has on the global economy. And I think you're going to see a backing away of some of the border tax adjustments, which is really a tax, right? It's really a tax on the U.S. consumer who's buying foreign goods. And that simply is going to create a much stronger U.S. dollar, which really runs counter to many of Trump's economic goals. So I think you're seeing, Eric, a little bit of a backing away of some of this harsher language toward China and finding a little bit of a middle ground there.
So do you think there are some positives that could come out of the China-American relations here in the years ahead?
I do. I think first and foremost is there's such an opportunity for better communication between the first and second largest economy in the world. I think certainly understanding China's perspective, if it's around things like the South China Sea or their views of neighbors, understanding their perspective, I think, is very much needed. But certainly I think there's also great opportunities for not only U.S. investors, but U.S. corporations going into China. And we're seeing that taking place. We're seeing U.S. companies doing quite well in China today. It's really the ones geared to the consumer that are being quite successful.
Okay. Well, let's talk a little bit more about that and sort of shift beyond Trump. What challenges and opportunities do you think are ahead for China in the next couple of years?
I think this theme of the reorientation away from China's economy, from export-driven manufacturing to domestic consumption, is just an incredible opportunity for investors. Most investors don't recognize that 50% of China's GDP now comes from the service sector. We're overwhelmed with export-driven manufacturing numbers or when it comes to China, but the simple reality is 50% of China's economy is driven by consumption today, and we want to get in front of those trends. The second trend we can talk about is the opening up of China's mainland capital markets. Both the equity as well as China's onshore bond market have had limited exposure to foreign investors, and that's changing very rapidly and can have a dramatic effect as those exposures are included to broader indices, both equity and fixed income.
Yeah, and I know MSCI is talking about doing a little bit of a shift as far as China exposure is concerned in some of their main indexes. Maybe you can speak a little bit more about how that might impact Chinese investments going forward.
Historically, the definition of China for investors from an indexing perspective has been 150 Chinese companies listed in Hong Kong. Those companies, from a sector perspective, are heavily oriented to the traditional sectors of China's economy: financials, energy, basic materials, and industrials. That definition is true not only for indexers, but also when you look at what active managers tend to own, it tends to be that limited definition in Hong Kong. That trend is evolving, where just over the last year and a half, MSCI has begun to include U.S.-listed Chinese companies, and then they're debating including the Shanghai and Shenzhen-listed companies within their benchmarks. Shanghai and Shenzhen stock exchanges are the third and fifth largest exchanges globally, over $6 trillion in aggregate market capitalization, and nearly 3,000 stocks. So we've really only scratched the surface in terms of this very limited definition of China, and that has the potential for, currently China makes up of around approximately 25% of MSCI emerging markets. The full inclusion of the onshore market, onshore equity market, will almost double the weight of China within indices. And so I firmly believe investors need, one, you're going to need a better source for good China information, and certainly we here at Crane Shares hope to fill that void. But also, certainly, we think there's opportunities in getting in front of these potential inclusions. And further afield will be the inclusion of China's bond market. China's bond market is the third largest bond market in the world and currently has a 0% weight within fixed income indices. It's just really going to be fascinating when the third largest bond market enters into those indices. It's going to have a very dramatic effect.
Wow, yeah, that's some sizable numbers there. But from what I can understand, it's not a done deal that they're going to enter into these indexes this year, right? It's still a little bit of a debate. Is that fair to say?
That's true, Eric. It's been 3 years running that MSCI has put China up for inclusion, and 3 years denied. So in mid-May, early June, we should have the next release on whether or not this onshore equity market will be included. But we think there's been a lot of changes to really appease or take into MSCI's why they've not included it over the last 3 years. And I think the odds of slowly being raised, and we'll see what takes place in the months prior from Chinese regulators to try to make that happen.
Yeah, what is kind of the holdup here, given that they've sort of swung and missed for the last couple of years?
Yeah, I mean, the main thing has been just capital access as well as some of the regulatory rules in mainland China, certain repatriation or the ability to move money out of China within select quota programs. But there's been a real evolution over the last year. China has really opened its doors and really addressed many of these issues. So I think the probability has certainly increased just based on, China wants this to happen. They want to see that foreign capital come in, very stable, longer-term investors. And certainly last year we saw the International Monetary Fund included China's currency, the renminbi, as a reserve currency. So I think 2016, the number one priority for Chinese regulators was to get this IMF designation. It's about national pride and recognition that this is the second largest economy in the world. And this year it's going to be about doing whatever it takes to get the MSCI inclusion. And I think shortly thereafter you're going to start to see some of the fixed income benchmark providers like a Bloomberg Barclays start really thinking and talking about the inclusion of China's interbank bond market.
Okay. And you know what? Let's focus a little bit more on the sector information. You briefly highlighted it earlier. I've noticed tech and consumer is also more of a focus for the Chinese government, at least in terms of their most recent 5-year plan. Perhaps you can talk a little bit to the listeners out there who might not be too familiar with 5-year plans, how this sort of governs Chinese policy in any way, and why the shift more towards tech and consumer and sort of the pullback away from the heavy industries like materials and energy.
It's a great question, Eric, and great observation on your part, where China provides a economic blueprint that they set out goals for each of the next 5 years, and we recently had their 13th five-year plan. So as an investor, we believe it's a very intuitive strategy to read the five-year plan and understand where the Chinese government is focusing their efforts. So as they continue to try to alleviate export dependency, they're going to be very focused on really, call it new China themes and sectors. So that's going to be areas like raising domestic consumption. So what can they do to help stimulate more domestic consumption? Really implementing technology within their economy, addressing environmental pollution issues, another big factor in China, as well as providing more access to health care. So we as investors, we want to own those sectors of the capital markets that the Chinese government is focused on. You're really almost sitting on the same side of the table as the government. We think that's an intuitive strategy, and our Crane Shares Zacks New China ETF, KFYP, really implements that strategy, really makes this idea investable.
Yeah, let's talk a little bit more about the New China ETF, KYFP. And just in terms of full disclosure, I wanted to point out to listeners that this is a Zacks index, but perhaps you can talk a bit about how this product goes about selecting securities and, does it shift based on each five-year plan? I think that's another good point to bring up as well.
Well, it does, and certainly in partnering with Zacks Index Services, we have a great partnership on taking this idea of ours and making it investable for investors. And the first thing that it does, which is unique, is we look at stocks, Chinese companies listed on the Shanghai, Hong Kong, New York Stock Exchange, and NASDAQ. So KFYP, first and foremost, is the only exchange-traded fund globally that we're aware of that holds stocks on those four stock exchanges. So that's in advance of MSCI's potential inclusion of Shanghai-listed companies. We want to get access to those companies today. We're then applying a liquidity screen, really eliminate, certainly KFYP provides daily liquidity for investors. We're then looking at what are the economic sectors highlighted within the five-year plan and which ones are not. So within the last five-year plan, you don't have a lot of those traditional sectors, traditional drivers of China's economy highlighted. We have these new China sectors. So we're eliminating companies that are in sectors that aren't highlighted, like energy. New energy is included, but coal-fired electrical plants are not. That's part of the problem around pollution. So we don't want to hold those stocks that we know potentially are losers within the five-year plan. And new energy is certainly one area of focus. So we're then looking, applying these sectors within the five-year plan, really linking that to sectors and subsectors, and finally companies that fall within those sectors. We then apply a really two smart beta type of screens. We're looking at price to cash flow and free cash flow, really applying a fundamental value analysis. And then we're applying a technical score analysis, which is looking at 3-month momentum and 6-month volatility. And from there, we then rank all of the stocks, and we're buying really the top companies within that area. So, we think it's a very intuitive strategy from a top-down perspective, and then applying smart beta screen to these strategies. And ultimately, we've had, knock on wood, some nice performance since implementing this strategy. So we think the proof ultimately is in the pudding. It appears to be working thus far.
Yeah, and I notice, at least in terms of the most recent fact sheet available, there's a sizable chunk of exposure in the tech world. Maybe you can speak to, what types of areas in the technology world this product is focused on. Is it, more software? Are we looking more in the internet segment? Any sort of spaces that this fund is zeroing in on?
Yeah, certainly we are relative to a traditional benchmark like MSCI China. We're very much overweight technology, consumer discretionary, consumer staples, healthcare, and then underweight a lot of those kind of old sectors like financials and energy and telecom. So I think a company investors might be aware of that is one of our top holdings is a company NetEase, listed here in the United States. And NetEase is almost like a portal into the internet. It's a combination of like Yahoo and the old AOL. It's almost a way people enter the internet, and you have your news stories. NetEase really started the Twitter of China, a company called Weibo, and several years ago, they spun out. They maintain a very high ownership of Weibo, but they spun out Weibo to shareholders as a way to try to unlock a lot of the value in NetEase that the company's management, which is major shareholders of the company, and certainly the founder is the current CEO of the company, so an attribute we like, as well as a major shareholder, in order to unlock the value that he felt that the market wasn't recognizing the value of not only Weibo's ownership by NetEase, and to do so, he really spun out Weibo, and NetEase has been just a very nice performer over the last really 2 years, and certainly we think it's a very interesting, very dynamic company, and we like the idea that management has a fairly large stake within the company.
So where do you see KFYP fitting into an investor's portfolio? Do you view it as more of a replacement for China or other emerging market exposure, or as more of a complement to what investors might already have?
I think it can be a great complement, or it helps an investor in broad-based emerging markets, really to allow them to overweight these new China sectors and do so utilizing a smart beta screen. At the same time, we think that can complement both active or other China and or emerging market exposures. So we see the product utilized in a variety of different ways. But really, ultimately, we feel like China, there's been a lot of misperceptions, and it's certainly the performance of the economy over the last several quarters has been quite strong. And we think as investors really come to recognize that, you're potentially going to see more flows headed into not only, say, broad-based emerging markets, but potentially to China directly, and hopefully we'll be beneficiaries of that.
Yeah, why do you think there are so many sort of misconceptions about the health of China's economy out there? It seems every other month or whatnot we read a news story about, people panicking about China, but as we've seen over the last couple of years, they keep chugging along. So, why are people so focused on this idea of sort of a China collapse that never seems to come?
Yeah, it is interesting. I mean, I think one element is just media has evolved, that we've kind of gone from all the news that's fit to print to a lot is really driven by almost how do you get people to read an article, and it's these sensationalistic or apocalyptic headlines seem to draw more clicks. So I think you're seeing the rise really of almost sensationalistic news as opposed to real news, and a country that's on the other side of the world that it's maybe at times harder to get good information, makes it more susceptible to some of those kind of sensationalistic headlines. At the same time, for myself, having traveling to China frequently, it's you really see when you go to China, just these incredible cities, and it's a very different experience there. And we want to provide within CraneShares, we want to provide a balanced perspective. We're not propagandists, but we feel like there's so much media attention to the liabilities in China. But if you're going to treat China as a balance sheet, shouldn't you look at the assets? And we want to provide some highlights around some of the assets. And certainly the economic numbers have been quite strong over the last few quarters, Eric, and we think it's really been a very underreported story, and I can't think of a better way to exhibit that than the performance of KFYP.
Yeah, definitely. All right, well, thanks, Brendan, for coming on and talking about China. I think this is a really good discussion on what is an in-focus topic for a lot of investors out there.
Thank you very much for the opportunity, Eric.
All right, everyone, that was Brendan Ahern, CIO at CraneShares. The fund that he discussed trades under the symbol of KFYP, and as a reminder, it is an index built by Zacks Index Services in the interest of full disclosure. Well, hope you enjoyed this edition of the Dutram Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find the Dutram Report on iTunes and give us a review there, and let us know if there are any topics or questions you have for us at podcast@Zacks.com, my Twitter page @EricDutram, or leave us a comment on Facebook as well. Be on the lookout for a new edition of the Dutram Report each and every Thursday. And until then, for Zacks.com, I'm Eric Dutram.